Hi, everyone. Thank you for joining us today. My name is Marche, and I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar today as appropriate, and I will be moderating those. If you ask a question in the chat box and we don't have a chance to answer it, please go ahead and leave your phone number as well, and we will make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. David Babb is the co-founder and principal of Stonebridge Asset Management, LLC. Stonebridge Asset Management is a registered investment advisor serving individuals, families, and businesses with investment and financial advising. Mr. Babb is also a minority owner of Coulter Bay Strategies, which serves as a general partner for the Yellowstone Fund, a limited partnership investing in Bitcoin. And he is also very experienced with alternative investments. And so we're excited to have you speak today, David, and tell us more about this topic.
Well, thank you, Marche. A pleasure to be here. I'll just say thank you, everybody, for spending some time with us today. We know that you've got plenty of options and lots of things, and everyone's really busy. So we definitely, thank you to just participating. And again, as Marche said, don't hesitate. Use the chat box. Ask any kind of questions that kind of pop into your mind. We'll go over a lot of topics, all under the umbrella of alternative investing. And how we'll do that is we'll just focus on, what's a traditional portfolio, and then how that's turned into investing in alternatives, some of the language that's used, some of the things that you hear, you'll hear alternatives, or now it's been shortened to alts, and even into the idea of, liquid alternatives. And we'll just kind of dive in and explain all the different things. So that's really, what the hope is today. And again, at the end of this, we hope everybody's a little bit smarter about, how to think about your portfolio, and maybe a little bit, a couple of interesting things. Maybe you could add some things into your portfolio or not. And as always, this isn't, as you saw the disclosures, not a solicitation to buy or sell. And certainly always consult, your financial professionals before making any investments. So with that, Marche, if you want to pop that first slide, we'll dive in. So when I said traditional portfolio, basically what most people think of, it's, stocks, it's bonds, it's cash. And then, there's many, many stocks you can buy, many different types of bonds you can buy. And of course, cash is cash. And you also hear these allocations and so like traditional allocation, you hear 60-40. And some people may be like, yeah, I hear it, but what does that mean? The idea behind it is, well, I want some type of balanced, or the word diversified portfolio. So like not all of my things are doing the same thing. So when I say things, not all of my investments are doing the same thing at the same time. So it's more of a, what do I have in my portfolio that can kind of offset or balance out? So if the stock market's going great, then I want to participate in that some way, shape, or form. But if it's not, I want something in my portfolio to kind of offset that. So and so that's where this idea of 60-40, that kind of became the standard, if you will, for the every person portfolio, just 60-40, 60. And again, what that's saying, 60% in stocks or 60% in riskier assets and 60% or 40% in less risky assets. And then that combination over a long period of time tends to work out. You make money in the good times, and in bad times, you don't necessarily lose as much money if you were 100% in one or the other.
Can you talk a little bit about how mutual funds and fit into that as well?
And so that's really, when we say like mutual funds or exchange traded funds, or we say, a stock or a bond, really there's five, or let's just break it down. There's four things that you can actually invest in. So you can invest in a stock, you can invest in a bond, you can have cash, okay, which is an investment, or you can invest in real things, real estate or minerals or precious metal, so real things. So stocks, bonds, cash, and real. And now from there, a mutual fund, an exchange traded fund. These are all kind of wrappers or mechanisms that allow different people, whether that's an individual or even up to these giant institutions or pension funds. It's just, how do you get access to that investment? You can buy, if you wanted to buy Walmart, there's plenty of ways you can just individually buy a Walmart. Or if you want to buy a mutual fund where, you know what, I don't know enough about Walmart just to buy Walmart, but I do want to buy something in the consumer discretionary, or, with the pandemic, it seems like Walmart's done a good job, hearing stuff about that, or that particular area or type of company's done. So a mutual fund allows you to buy, you'll get exposure to Walmart, but then you'll also get exposure to other companies or stocks of other companies that are similar to Walmart. So a mutual fund kind of builds in diversification. So a mutual fund's designed for a person that maybe doesn't have the time to do all the research they need to do on any one particular thing, but knows that they like, hey, I like these types of companies. I like this type of stuff. And so they're able to then buy it. There's a again, an easy way to add it to your portfolio. You have your brokerage account, and you're able to buy a mutual fund. An ETF is more or less the same thing with some nuances, and it gets into tax treatment, and that you can buy and sell it at any point in time in the day on an exchange traded fund, where a mutual fund, you can put an order in to buy a mutual fund, but really that mutual fund's only being bought at the end of the day. So you're kind of subject to whatever happens during the course of the day, whether the price is going down, which would benefit you if you're trying to buy it, or if the market keeps going up, well, you're going to pay a little bit more at the end of the day. Where an ETF, it's more what's going on at the time you try to buy it. But they functionally are trying to do the same thing. Create diversification, allow individual investors to kind of round out a portfolio. And if you've got a ton of money to invest, then maybe you got enough to do an individual stock portfolio. But if you don't have a ton of money to invest, you're just getting started out, mutual funds and ETFs are great ways for you to get exposure, to this. And there's all kinds of shapes and flavors and sizes of these mutual funds and ETFs. So basically, if you've got we'll call it a thesis, if you've got an idea about an investment, there is a product out there that will let you invest that way. If you're environmental, if that's a big issue, well, there's now lots of mutual funds and ETFs that really focus on environmental, social, and governance. So they're called ESGs. If you want a particular sector, you're a big fan of technology and you think, hey, the future's in technology, well, then you can buy either a mutual fund or an ETF that's specific to just technology, so you can kind of make that allocation, if you will, or again, your thesis. Hey, maybe you work in the tech industry, it well, and that's where the growth's going to be. So mutual funds and ETFs are more democratize the idea of investing for everybody, so that's really it. And you see A lot of mutual fund investing is going to be inside of your retirement. So if you have the opportunity to invest in a 401k, you're going to get a lot of this asset allocation, like, hey, 60-40, and then you're going to see a lot of mutual funds and things like that to help you round out your portfolio. So you're going to see mutual funds there. In brokerage accounts or individual IRA accounts, that's where you can do stocks, bonds, cash, or ETFs. There's very few, because I don't want to be too general and say all 401k plans, you can't do that. But many of the 401k plans, try to force you into diversified investment pools like mutual funds. So a lot of words. Did that kind of touch on?
Yeah, no, that is way more information that I asked for, but it was great. So thank you very much.
Yeah.
It's great to have your perspective on that. And then I think we can go on to the next slide. So here we go.
Okay. And again, the whole idea, I talked about this, the whole idea about diversification. So what's supposed to happen is in your portfolio, you're supposed to have something that in good times is going to react a certain way. And then something in bad times is going to react a certain way. And then when you combine those two, that's where you get what they call diversification, or to take its statistics, the statistical terms or things you may have heard, you've got correlation or non-correlation. So how do the two things, how do the two things react independently? And then how do the two things react to market stimulus connected to each other? Do they move in the same way? So they'd be highly correlated. And if that's the case, they don't really give you diversification. Or do they actually move opposite each other? And if so, then they are giving you, diversification, because they're non-correlated or not as highly correlated. And you've got varying degrees, to where you can have, but it's all ranges between the number 1 and -1. So perfectly positive correlated, meaning they move in lockstep. That's a correlation of 1. And then -1, they move opposite, perfectly opposite of each other. And again, this is just mathematical processes that you may go through and trying to build. It doesn't really exist, because what we've learned from, say, 2008, 2011, even most recently with the pandemic, that a lot of investments, no matter how diversified we think we may be, in times of extreme pressure and extreme market dislocation, they all react the same way. And so we learned that lesson the hard way in 2008, where you had people like, well, I don't know about the stock market, or I don't know about the bond market, but I know this: I've never lost money in real estate. Well, hello, 2008, so thanks for that. So now you had the opportunity in your diversified portfolio to lose money in real estate as well. So that's where the idea of, what I own, is it really diversified? Does it really help in times of extreme pressure? Because something that we've kind of noticed with our clients is everybody is aggressive. Okay. All clients are aggressive. And if they're not there, they'll eventually get there, as long as the market's going up. It's when the market starts going down that we really find out where your real risk tolerance, your appetite for risk is when you're actually losing money. So it's kind of like the Mike Tyson approach, where everybody has a plan until they get punched in the face. And, and that's true. I mean, back in Mike's heyday, guys that had prepared for many, many months to fight this guy would, 8 seconds later, they're laying on the canvas. So, so everybody's got a plan till you're sitting there bleeding going, oh my God, what just happened? So that's where this idea of alternatives started to really become. So in the 90s, exposure to alternatives was really more for endowments or huge institutions. You hear about these Yale, Harvard, and their billion-dollar endowments, or pension funds, massive pension funds. And it was just a way to get exposure to stocks, bonds, cash, and say real estate or real assets. But they were doing it in ways that were trying to be a little more unique, a little more direct in things, to avoid everything being correlated in their portfolio. And so that was the idea. And there was some real advantages to having that in the portfolio. And you saw that kind of play out through the course of, say, 2000, 2003. So if you look at the 2000s, early 2000, you had the tech bubble and you had it burst, But if you weren't 100% exposed to technology, then your portfolio, only the stuff that was in technology was getting kind of hammered. And so these alternatives are just different ways to own some things, or being diversified beyond just, what was hot at the time, bode, really, really well. And then, then you kind of take it on through and how this started to develop. But again, it was designed and these structures were put together. It really wasn't available to every person. And in 2008, you had this thing where, again, if your stuff was correlated, and for the most part, everything was correlated, if you owned it in ways that, with not a lot of thought being put into your portfolio or oversight being put into your portfolio, then, you experience something pretty negative. And that's kind of 2008 on is where there was another aha moment in the marketplace where they said, you know what? Alternatives may be good for not just
Looks like we lost you there for a second, David.
adding and putting that, into their portfolio.
David, can you just repeat that last part? You just stalled out.
Oh, did I? Oh.
Yeah, so you left off of where in 2008, the market realized that the alternatives wouldn't necessarily be only big institutions could use them.
Well, again, we recognize the opportunity or the need for alternatives. Now, that's where, again, people's investing and their appetite for investing, started to change. And it actually was happening a little bit before then. It was more like in, say, 2007 or so, 6, 7, where markets started changing. And so access to some, strategies that potentially could help you in the portfolio started to kind of, move more mainstream or move more into Main Street, if you will, and being accessible and available for individual investors. So
okay.
Did that kind of connect it?
Yeah, that helps. I mean, people have always, I guess the question I have is people's always have owned their homes and maybe owned businesses and maybe owned those things on the side privately. What are you saying about how the investing market changed?
Well, and again, owning your home. And so to some degree, you bring up a good point. Say a business owner, you have a lot of your net worth tied up in a small business. So in my opinion, in terms of looking at your asset allocation, you have a high concentration of small cap or small company stock in your portfolio. So you should, as building a portfolio, you should be looking to, well, I don't need any more small cap in my portfolio. Maybe I need some big companies, and maybe I need some, something different to own that. And same with real estate. I've got my house, but again, we like to say you can't eat a house. So the idea of being liquid or staying liquid, what other things do I own? Where my home, I don't necessarily think of it as an investment, although it happens to be most people's largest asset. And you have to look at that with a little more longer term view, but there's some investments you can make and some structures that you could utilize that would give you additional exposure to real estate that actually made you part of a pool that owned apartment complexes where you were getting some revenue streams coming in. And again, interest and dividends coming into your portfolio on a monthly or quarterly basis go a long way to offset market volatility. Even if the market goes down, I've got interest and income coming in. So that kind of, balances out. Now, in extreme dislocation, it'll smooth the ride some, but it won't. So the idea was, hey, let's really start to rethink what we're doing in our portfolio. So from that tech bust, then 2003, then you had the run up. People started to look at real estate as an opportunity. And ultimately, where there's a will, there's a way. That appetite to have an alternative in investments and have it exclusively in real estate, ultimately created a big problem in 2008. Then we see that market pop, and that market then how it in times of distress, really created dislocation in the market. A lot of people panicked. A lot of people, lost a lot of money at that period of time. But again, just we'll call it an opportunity to rethink, okay, how are the pieces in my portfolio there? What's going on and how do they work together? And so this idea of, does it make sense to have these alternatives in my portfolio or not? Does it make sense to have, and you'll hear people say hedged, is it a way to hedge some of the risk in my portfolio? And so it started this kind of path, to kind of have people relook at and think about, really what was going on in their portfolio. And again, in say Wall Street or banks and things like that, where there's an appetite for types of investing, well, they'll figure out and create products to make it accessible.
All right.
So at the end, we kind of hit this, and I'll touch on this just briefly. So real estate we've already talked about. You hear a lot about cryptocurrency as a possible investment inside your portfolio. You've got direct investments, like you say, businesses. Whether you're a partner in a business, whether you're an investor in a business, whether that's a creditor or a equity shareholder. And then, like I talked about, you've got timber, farmland, art, collectibles, precious metals, and now it's just how does that actually wind up in your portfolio? Most of us can't just show up at a Sotheby's auction and buy one of these paintings and then go hang it on our wall and be, hey, that's our investment. 10 years from now, we'll auction it again. So it's the idea of these liquid alts or alternatives create and make an opportunity for you to add this into your portfolio. So again, through mutual funds, through ETFs, with the exception of cryptocurrency, there's no current ETF that you can buy that'll give you exposure to cryptocurrency. The only way in the United States you can get exposure to cryptocurrency is either to use a limited partnership, that's something we'll talk about in a minute, or to directly go to an exchange and buy and sell. And some of the exchanges are like Coinbase or Square, Robinhood. Those are some things that you could actually go and directly buy. But in real estate, there's funds that you can do, mutual funds or ETFs that give you exposure to real estate. The same with real assets, mutual funds or ETFs that you can get exposure there too, because not everybody can just go buy a farm. But owning farmland in your portfolio makes some sense, for a long period of time. And then to do direct investment, again, those are done through limited partnerships, or trust, or you go and start a business. So. And again, we talked about this, there's the key to this, and we'll just look at it because is making sure that you understand what it is you own and you understand the structure that you own, okay? Because a mutual fund, we know that we can put an order in and we can get our money back if we don't like it. Doesn't mean we get all our money back. There's risk involved with investing. But I could say, you know what, and call my advisor and be like, I need to sell. I don't like that particular fund. They're able to sell it. When you start to move into unit investment trust or even limited partnerships, the liquidity starts to go away. And that's something that I think people need to understand. And that's one of the reasons why up until, say, the last, 15 years, it wasn't as available to individuals because there was a liquidity premium where you needed to understand that if I own a particular investment, I may not be able to get out of it as easy as I can, out of a mutual fund. And so they created a set of, we'll call it criteria. You needed to be a certain thing. You needed to make a certain amount of money. You need to have a certain net worth because supposedly if you made a bunch of money or if you had a certain net worth, that made you smart and you would understand all this stuff. No matter what, no matter if that was your job or not, you could understand a 180-page legal document implicitly and know exactly what it all stood for and how to invest in it. But really it boiled down to liquidity. So that's been, when I keep saying liquid alts, that's where these mutual funds and ETFs over the better part of 2 decades or so, that's where they really kind of stepped in to provide structures or investment opportunities, but still keep it in that liquid form. So you're able to buy and sell. You're not trapped. So like limited partnerships. So, when we're looking at a limited partnership, it may have a 5 or 7 year hold. So if you put that in your portfolio in a limited partnership, you need to have the understanding, hey, I need to know that that money is going to be locked up. So therefore, you need to have working with your advisor, find out what kind of allocation it might make sense. You wouldn't want to put 80% of your investments in a limited partnership, because 80% of your investments are now illiquid, and if it doesn't work out exactly like you think, you could find yourself in a real pickle, a real liquidity crunch. And that happened with real estate in 2008, where maybe it wasn't a limited partnership. We just all went out and had individual homes and we were renting them and everything was great. But then when it all dried up on us, well, we were left with all these houses. There was no cash flow. People were moving out or people just weren't paying us, and our liquidity dried up. So that's the real consideration, in my opinion, to just looking at these things. And again, pooled investments, your risk is diversified. You're in and not just one particular thing, one particular house, one particular business, one particular precious metal. These pooled assets tend to give you diversification. So it's a way, again, to get exposure to this. It's going to be non-correlated in your portfolio and should give you risk return characteristics that are favorable, but also give you diversification. You don't have to become an expert in gold mining in order to, have some gold mining or gold mining companies in your portfolio. And I'll just say this, there's some what they refer to now as private investments, although in liquid wrappers, and they're called interval funds. And that's kind of a hybrid between the limited partnership and the mutual fund. It's in a mutual fund structure, but you can only sell it every 90 days. So that's one way for some of these managers to take kind of investments that have longer term profiles and try to manage, at least give you some liquidity, but not necessarily, do you have access to all your money like you would in a mutual fund or an ETF. So again, a whole lot of words, pretty complex stuff, but starts to make some sense as you look at it. Now, we've covered, again, a lot of this. You can own it through a mutual fund. You can own it through an ETF. You can own it, if you wanted to own it directly, you can. As we mentioned with, say, the cryptocurrency, or if you're a precious metals person, you can go buy gold and have gold and put it in a safety deposit box, and it'll have some value to you. It's hard to spend because I don't know too many grocery stores that take gold, but, hey, you never know. You never know. Flake off a little bit for them and get your vegetables, that might work. But the whole idea of it is to, why do I own it? What are my expectations? And typically when people own alternatives, the idea is not to catch lightning in a bottle and make a lot of money. As a joke, I would say that's what meme stocks are for. But you want this to help reduce some of the risk in your portfolio. And then again, how does that impact my portfolio? You want it to reduce or lighten up the risk in your portfolio. And it's more about the really bad times than it is the good times. Don't get, if you're looking at truly building and truly have a long-term investment horizon, you can't worry too much. Well, the market went up 18%, and again, when you say the market, that can mean many, many things, but let's just call the market the S&P, so the market's up 17%. Well, unless you owned and your whole portfolio was 100% the S&P, and that's all you had, so it's just stocks only, then your expectations should be that you should also be up that, so you should be up. But if you have a 60-40 portfolio, and I say 60-40, if you have some kind of diversified portfolio, then again, your expectations, hey, I've got some in stocks, but in case the stock market doesn't go up, I need to have some in some things that don't. And again, is a possible solution looking at these alternatives or liquid, alternatives. And again, it should help you on the downside, not necessarily knocking it out of the park on the upside. So there's this kind of trade-off, and folks, if you work, again, what's the money for is a great question to ask yourself when you're looking at your retirement fund, or if you're looking at a brokerage account, hey, what is the money for? It's for me to spend in retirement. Well, then that creates a set of investment principles around it. It creates a time horizon. It creates risk characteristics. I need to grow it to this level in order to do these things. How do I get there? And that's where, working with an investment professional helps, working with and coming up with a plan because, hey, what is this money for? Then dictates what are the types of things I can invest in, what is my time horizon, and what sort of investments can I put in there? If I've got a really long time horizon, well, I can look at some things that aren't as liquid, that maybe are a little more alternative, but, because I've got 20 years for it to kind of play out, there's little to no chance that I'll need the money in 36 months. I'm good 10 years from now. So I want this to have to work and play itself out. And so again, risk tolerance are different for each individual, but also each individual inside of their own portfolio. I've got my money for retirement, but I'm also saving to buy my, first home. So you've got two different things. And so you're going to have two very different portfolios for that. Your retirement money needs to be in the more aggressive side, but that money for the first home, you've got to have that kind of managed to a more conservative side because, you can't really, a lot of fluctuation can offset your plan to move into that first house. Retirement is something if you're 30, well, that's 40 years from now. So that's something that you need to kind of think about. And those are the kinds of things that, and what percentages do I need to have allocated, all start to shape and play themselves out for you as the investor. And again, reason to work with, work with a financial professional, kind of work through these things. So. And again, we've touched on this, that again, all things in moderation, I guess, is the way to kind of live. But again, liquid alternatives, by their nature, liquid, we talked about that. So the mutual funds or the ETFs that kind of have that moniker, are liquid or are liquid to the respect of about every 90 days you can have access to them. If you are in a space where you're playing more or looking at, say, limited partnerships or directly investing in a particular business or a particular thing, again, not very liquid. So what are my expectations? Do I need the capital? When might I need the capital? When might I need the money? When might I need this, for the income off of it? So, there's where you start to, get into where, working with, again, that financial professional, talking to your accountant or, family member, attorney that you can kind of, hey, here's some things I'm thinking about, and what potential, and I kind of look at it this way. What am I missing? Like, hey, what hole what unintended consequence am I about to have? But again, you have these unintended consequences. It does become harder to manage with respect to if it goes wrong, how do you get out of it? How do you recover? What is your kind of exit strategy, if you will? So that's the kind of the cautionary tale. To when we're looking at these non-traditional, investments or non-traditional structures that you may put into your portfolio.
It sounds to me like, and here's a question, that a lot of people are already invested in alternative investments, but they don't particularly know that that's what it is. Maybe not structurally in maybe an investment account, but a lot of people own businesses. A lot of people own investment property. A lot of people own collectibles and things like that.
That's right. And so you already own it. So again, when you're sitting like on paper, maybe it doesn't show up on your brokerage statement, but everything, again, you own these. Why do you own this? Well, there's value, and you have a value. And then at what point am I going to do with it? You know what I mean? So if it's a collectible and you happen to own a particular, let's say you're a huge baseball fan and you've got these cards and they're worth a lot of money, but what you want to do with that is that's going to your grandchildren or something like that, so there is, again, everything should have a use case or have an investment, process around it. And it needs to kind of get tied into your overall picture. A lot of times, not just, hey, what's in my 401k and what's in my checking account is my net worth. And so there's a lot of available to you. Some, again, you're working with an advisor, they probably have something, but you're able to kind of create, a total just one-stop shop where you've got a picture of your net worth. And it would include, hey, my small business. I think my small business is worth X. And I think I'm going to, my son is going to come up and keep working in it. But at some point I'll step away. And when I step away, or my daughter is going to come up and work in this. And when I step away, that will equal X to me. That will be some value to me or some cash flow to me. The same with, hey, I own this piece of art. That's worth a lot. I'm going to sell it, or I'm not going to sell it, but maybe it stays in the family as for generations or something like that. Or maybe, and in some cases you can get into where some of these collectibles, and and this is kind of getting more definitely for your CPA, but you could, in some cases, you could have some highly appreciated things. You can, for tax reasons and tax purposes, you're able to use these alternative investments. You make a donation, your charitable contributions, and then that has, kind of takes and has a life of its own. So it's just the idea when you really do start to look at your, what am I doing and why am I doing it? Why do I own these things? Why do I own this life insurance portfolio? Whatever. Why do I own this piece of art? Other than, hey, it brings me a ton of joy. I love looking at it. That has value to you. Doesn't mean that it's going to be worth $1 million, but again, but there is value. And, again, just trying to get you to think about, because not a lot of business owners think about their portfolio or their small business as, hey, I've got a highly concentrated small cap stock. I have a highly concentrated small company, stock, and I really don't need to own any more of that in my diversified portfolio. I got all the small cap I need because of my own business. Now I need to be putting money into other things, the things not related to or will react differently again as I try to build a diversified portfolio. So you think, was that kind of getting at it maybe?
Yeah,
helpful?
Exactly. I think that's what the question was addressing there.
And we've said this, all things in moderation. And my favorite is you can't eat a house. And again, that means you got to stay liquid. There could be an amazing investment opportunity, but if it's taking up all of your, what I refer to as like the, oh my gosh, money, you always need to have this kind of idea that it might not work out like I think. It doesn't mean you don't do it. It just means, hey, what if this goes wrong? So you almost have to think of it in reverse. Here's an opportunity. What's my exit? What's my out strategy? And in good time and in bad, because everybody gets excited. No one gets into something because they think it's going to fail. No, that's, hey, I've got this great idea. It's going to be terrible. Give me some money. That's not going to happen. Hey, I've got this great idea and we think we're going to make a lot of money, so everybody's like, yeah, okay. But the idea is, hey, what is this in my portfolio? What is it going to do? What do I have in my portfolio that can offset or help me get through a rough time? Because if I've got a bunch of houses and they've been generating income, I don't want to have to sell my homes, be forced to sell my homes in a 2008 environment. Because now because I didn't necessarily manage my portfolio well, I didn't have enough liquidity, I have to give away, things that I know have a lot more value than what I'm having to sell them for. Like I bought this for $100,000. I've had a renter in there forever. It's generated $100,000 of rental income to me over the years that I've owned it. But now I have to sell it for $50,000 because I had 100% homes, rental homes in my portfolio and nothing else, no other. And so that's really, you don't want to be a forced seller, because then you have a lot of the opportunistic buyers just licking their chops to come in. So the guys that do have liquidity, that's where liquidity in a crisis is king, and you can almost dictate your terms. So that's where, again, moderation and why do I own it? But, and again, in some of the alternative space, some of the non-traditional things that you own, the less liquid things that you own, what if, And if this doesn't work, where do I go? So it doesn't hurt. And it's not something you have to dwell on or think about. It's just as you kind of review your portfolio, you're seeing things move up. Hey, my company's never been done better. My company's never, had more A, B, or C. Those are great opportunities to start to think about, okay, what's kind of the succession plan for my business, or what's the next step for my business? You don't want to then go from the best year ever, 2007, to the worst year ever, 2008. And now you're a forced seller, of your small business. So again, a little bit of planning, a little bit of thought. And like I say, my favorite, you can't eat a house, meaning, if everything's illiquid, then you're stuck. You're basically asset rich, but you're cash poor. So.
We had some questions about what it looks like if you go to a financial advisor and say, okay, I want to diversify my portfolio more. Like, I know nothing about.
Right.
I know nothing about alts, but I've heard I need to, that's an opportunity to
Is it a consideration?
Yeah.
And it depends. I mean, for every type of advisor, there's a client. And for every client, there's a type of advisor, because you have advisors that might exclusively want to talk to you about a dividend portfolio. And that's all they really do. And they basically say, over a long period of time, dividends, that's the way to go. And we'll create this income stream for you. And you'll never have to worry about it. You'll always, just over time, these companies pay their dividends and the stock goes up over time. But again, that's a very isolated instance, but there's guys like that. And that may be something that makes sense to you, and that may not be. I think you're going to find more advisors being in the camp, though, of looking at these diversified portfolios. It doesn't necessarily mean that they're looking at what used to be considered non-traditional asset classes, which are now becoming more and more mainstream. It doesn't mean that every advisor is going to be able to talk to you about crypto, but for the most part, I would say most advisors out there in today's market are going to have exposure to real estate, are going to have exposure to maybe businesses or small businesses, or what they refer to as maybe like bank loans, where you're looking at some ways to interject some of this into your portfolio. Timber, farmland, art and collectibles, precious metals, all those are finding their way into a more mainstream portfolio. And again, the real assets, those things can come to play or help out in times of inflation. Investment in kind of small businesses or bank loan type structures, those can bear out opportunities in rising interest rate environments. So there's different reasons to own different things. Real estate can give you an income stream that's not as correlated to interest rates, to an interest rate environment. So maybe, so there's those combinations. So I do think that most advisors are going to want to build a diversified portfolio for you. You, as the potential client of that advisor, you need to ask the advisor, hey, what's in my portfolio in case something goes wrong? If you're not right about, the fact that you think tech or growth is the way to go, or value is the way to go, what's in my portfolio in case you're wrong? And that should give you the conversation, or the at least the starting point, to let the advisor go and talk about the other things that are non-correlated, the alts or the liquid alts that should help mitigate downside. But if they start talking to you about time horizon, then okay, this guy maybe is a little more concentrated. Maybe so like the solution for a guy that only wants to put equity paying dividends in your portfolio, then you have to have a 50-year time horizon. Because the market goes down 30% like it did, when the pandemic hit. Well, you need time to recover from 30% down. You can't sell your portfolio, because if you do, you're toast. You have to allow everything, to work out. So if they're talking like long-term time horizon, then maybe you may want to press them a little bit to be like, well, what if I don't have 40 years? Or that's not really makes me feel comfortable. I don't want to see my portfolio go down 30% in a given, 90-day period. So I think just by asking the question, what's in my portfolio in case everything goes wrong? it should kind of give you a good jumping out point for conversation. Oh, are you on mute?
Sorry about that. Thank you so much for this information. I think that's about all the time we have for questions. And I wanted to encourage people, if you do have questions and we haven't had a chance to get to them, go ahead and leave it in the chat and make sure to include your phone number as well. And we will make sure someone reaches out to you to answer that or address that question if we can't do that right away. So anyway, I want to thank David for being here. Thank you for your information. Thank you for educating us a little bit more about these alternative investments. I found it very interesting. So
well,
thank you very much.
Wake up, everybody. But yeah, please do hit us up with any questions you might have. We'll definitely do our best to respond. So thank you.
Here at Advice Chaser, we're all about helping you find a financial advisor who's a good fit for your life and your financial questions. Our matching service is free to you. And every one of our advisor partners has agreed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, for Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Bye-bye.